Welcome to a special edition of The Ultimate Landscape CEO. Our guest is Greg Crabtree. He is from CRI Simple Numbers. It's a business profitability consulting firm, and he's a member of this larger CRI family of companies located in beautiful Huntsville, Alabama, also called the Rocket City. Greg Crabtree is the author of two great books on finances, and his first one was called Simple Numbers, slightly longer title than that, but that's what I remember. And his second book is also called Simple Numbers 2.0, Rules for Smart Scaling. I enjoyed the first book. Here's the title of the first book, Simple Numbers, Straight Talk, Big Profits. In any event, if you enjoy finances and learning about finances, you're going to love this podcast. If you're sort of on the beginner's journey, you might want to read his book, and I would say read it anyways. He does cover a couple acronyms and techniques that you'd have to read the book to really understand what he's talking about in terms of ratios for labor and overhead. But we get into a lot of great aspects. He talks about his simple approach to business valuation, and I've been on a lifelong journey of learning about finances. I had my MBA where I studied finance. And even then, that was just a jumping off point. I've been reading many books on finances. And he's one of the key authors in my library. And so if you're on that same journey of wanting to get better and improve, you're going to enjoy this podcast and you'll enjoy his books. Here we go. Welcome to the podcast, Greg Crabtree.
Thanks for having me.
So where are you located exactly? I know there's a little bit of background noise. Looks like you're on the go.
I am always on the go. So my clients are all over the world. And so today you catch me in Fort Lauderdale, Florida in a hotel lobby trying to catch the call. So it kind of, just think of me as the business version of a sports analyst. You're just catching calls from wherever. So I apologize if there might be a little bit of noisiness, but I think the content will be worth it.
The least you could have done is been out by the pool so we could get a view.
Well, I could do that. I am looking at the intercoastal waterway at the moment in my view. So sorry about that.
So Greg, you are the first author besides myself that I have on, but really the first author as guest. Mm-hmm. And you've written two great books on finances. We, in my consulting practice here in the landscape world, one of the things we're known for is financial management. So I'm excited to discuss ideas with you. Tell the audience your books and about your practice.
Yeah, I started off as a frustrated accountant because accounting is not very fun and exciting. And I learned the skill set to then pursue. I've always had this idea that the consulting side of it was the most beneficial for the client. A lot of accountants chase consulting just because of the revenue aspect of filling in the busy, the slower times of the year. I look at it as it should be the prime product of what we do as a profession. And so as I developed my craft, actually the first client, I refer to him as Simple Numbers Client Zero, is a landscaper in Omaha, Nebraska, that we developed some of the early concepts and then just continued applying it to other industries and other businesses, so we've had quite a bit of work in this particular industry. But as I always try to remind people, industry knowledge is great, but business is business. And I like an eclectic mixing of business ideas, getting different businesses together so that they can learn best techniques, from each other. So our practice, I built my own practice, started in 1986, and then in 2020 we merged with a national firm, Carr, Riggs and Ingram. So we're part of the top 20 U.S. accounting firm now as a special practice unit, for that practice. And so we focus just on consulting. We'll do some of our clients will do the tax returns for those consulting clients. We do some specialized outsourced bookkeeping as needed, for those. But those are the only three things. So our practice unit no longer does any opinion financial statements. We pass those off to one of the other offices if it is needed. But it's kind of cool because I get to come to work every day and do something fun and really digging into business and figuring out here's here's a handful of things that matter and just keeping people laser focused on listen, you can't defy physics and you got to address these.
So you first came out with your book Simple Numbers. I know the title's a little
Mm-hmm.
longer.
Yep.
Love that book. And then you recently came out with Simple Numbers 2.0.
Yep.
And did you change any philosophy from one book to the other, or are they additive?
No, they're additive. The first one is more a mindset and philosophy book, is the way I describe it. Getting the entrepreneur's head around the idea of understanding, hey, here's the basic failings that I see constantly in our client base of entrepreneurs not paying themselves a market-based wage and therefore thinking they're saving taxes. They're just distorting profitability, which is a much more important issue than the little bit of payroll taxes that you think you might be saving. But then once you get to truth of data, then it's what data matters.
Mm.
And I mean, I'm just a big believer that historically, I don't care what technology does, at the end of the day, labor and revenue just match each other in relation to each other. One will surge ahead, the other one will surge ahead, but they just chase each other up the scale. And I think is and more importantly, even less than revenue, more importantly, gross margin. And so as we've learned this key technique, I'm actually about to present to a group of business coaches, about this concept of, the three things that I want them to pay attention to with their clients is number one, I want you to understand profit in relation to gross margin is the more important profit measure.
Mm.
Number two, total labor efficiency is your most important metric, which is gross margin divided by total labor. And then third, what is the cash balance you need to be considered fully capitalized? You do those three things, you're going to have a really financially healthy business and understand it and adapt to those numbers.
Can I just let me interrupt a second?
Yep.
So in my world, and in I think a lot in the landscape world,
Mm-hmm.
we define gross profit after labor, subs, and materials. Your
Right.
definition is after materials, correct?
After material, and so I'm saying gross margin, not gross profit. Gross profit is a term that is generally used. It is a little sloppy in its application. So I distinctly in the second book started using the term gross margin, and
Yeah.
this came from a discussion with Verne Harnish as I was writing a chapter for his Scaling Up book. Verne, I credit him with the insight. He said, listen, that word profit is kind of a sloppy term. People can get confused about it, and he said, margin with a modifier word should be a subset of an economic activity. And so we agreed on gross margin is revenue minus cost of goods sold without labor. Gross margin minus direct labor is contribution margin, as we call it, which would be probably in most cases similar to gross profit
I agree.
in the way QuickBooks, the way QuickBooks calls gross profit, that would be contribution margin in our world.
Yeah. I refer to that as revenue net materials, just for those listening who,
Yeah.
work with me. But okay, good.
Yeah.
So I'm a big believer in profit has to have an owner's salary in it, market based. We call that net to owner in case they don't. So we just combine profit and owner's salary back. Let's talk about labor efficiency. That's where it gets exciting.
Yep.
In my world, we use a term called throughput, which is basically your gross profit or gross margin, but we divide it by labor hour and you're dividing it by labor dollar. I like your approach.
Yeah, I mean, so dollars is your key because the reason why we isolate labor, and our simple numbers philosophy is always never ever ever mix labor with something that's not labor, because labor is the only cost that comes to work every day with an attitude. It has some good days and it's got some bad days.
Right.
And so an hour is the same thing. An hour is not a tangible unit of productivity. It is really what economics got generated, from what that person did. And so when we get hung up in hours, yeah, I mean, I'm not saying don't look at it, but to me, it is clearly a second or third level analysis. it, at the end of the day, I make money or not because what margin did I produce for the dollars of labor input? Labor
Yep.
is an input, margin is an output.
Yep. I totally understand. And, we're going to make you the star here, Greg. So we'll avoid big debates and keep them small.
Yeah.
Um, and so you're about to coach a bunch of coaches, profit, labor efficiency. So how do you want us to look at labor efficiency?
Well, what's fascinating is, I mean, we study hundreds and hundreds and hundreds of business data sets all the time. I mean, and the unique thing about our practice is, we grab our clients' data every month, so we're constantly touching it. We've got our own economic index we call the Simple Numbers 100, which is we take 100 of our clients, it's a little over $1 billion of revenue from all different geographies in the U.S., all different industries, and
Yeah.
it's our read on the economy. And
Yeah.
so with that research that we look at, one of the things that just jumped off the page is the fact that probably 90% of the business models out there operate off of one economic standard to be profitable. I got to get $2 of gross margin for every dollar of labor, regardless of what that labor does. I don't care if it's direct. I don't care if it's CEO. I don't care if it's the floor sweeper.
Mm.
And to me, that is just fascinating. Now, here's where we fail in our discussion of business amongst each other, is we've determined that there's really three plays of labor in business. So when I take labor and split it between direct labor and management labor, and you can draw the line ever how you want it, it's less about the debate of what's direct and what's management versus, hey, just be consistent in how you evaluate it. But at the end of the day, there's three strategies. Number one is I can have really inexpensive direct labor, which means I'm going to have more expensive management labor to fill in the gaps of what they don't know how to do.
Mm-hmm.
I can run a balanced approach. I can kind of have moderately priced in both groups. And then I can have expensive direct labor. And this is where a lot of entrepreneurs, gravitate to. Oh, I have expensive direct labor. I don't have to manage them. So I must have skinny management labor then. Well, and all three of those can work. We've got industries that we look at data sets where people are clearly running all three of those plays and they can make it work. The challenge is when you run the play of expensive direct labor, you have nowhere to go and you start to get into margin compression.
Mm.
That labor continues to need raises to stay. They don't stay still. They have pressure from cost of living, although I claim cost of living doesn't matter. In the end, it is a force of the market that causes people to drive for higher wages. But you start to get into margin compression. The more and more that person makes, you just can't charge enough, to get the actual margin that you need. And at the end of the day, too, expensive labor still needs to be managed.
Yeah.
And so what we see as a trend right now are people probably culling a lot of their expensive people to reset down to the inexpensive people. Yeah, customer service performance is gonna suffer a bit, but it's just like a pro sports team where my salary cap got too high. I got to reset it, and I may have a tough year or two to grow it back, but I had nowhere to go. I was just not going to be profitable, with it going.
So
And
you're saying with the inflation raising direct labor up, people are cutting back management labor, and that's going to bite them.
well, they're cutting back both. They're cutting back both high paid direct labor. But here's the other trend. You're saying, we're paying people more and more money as wage demands still continue to go up, regardless of what everybody thinks. I mean, we're still seeing continual up in labor costs, but you're not getting any more margin out of it. You're not getting any more productivity out of it. And so, as I'd like to say, that's a math problem. And so, as labor is paid more to do less, the only place to cut is management labor.
Yeah.
And so management I got two choices. And when I do presentations, I show people this concept that we use in simple numbers of, when you're not at your targeted profitability, I got two choices. I can cut or I can grow into it. And we show them, we can mathematically show here's what the cut looks like. Here's what the grow into it looks like. Which one's the most feasible?
Yeah.
That's your call. Now we probably give you some experience of, you're whistling Dixie about thinking you're going to grow into it a lot of times. But there again,
they're
either way,
automating,
yeah.
right?
Well, but it's funny. I mean, automation matters. There's no doubt. But I will tell you, I could go back 20 years, 40 years, and look at financial data, and I will guarantee you one thing exists. The best run companies have $2 of gross margin for every dollar of labor 40 years ago. That number, you might run a little bit ahead of it when you put in automation. But you know what the market does when everybody automates? It pushes it back to the two. It's
is that
just the way it works.
labor, direct labor or total labor?
Total labor.
Total labor. Okay, gotcha. That makes more sense.
That's right.
I thought you said direct, and I was like,
no, total.
You're the guest. Didn't want to question you too much.
Yeah. Oh, you can question me anytime you want. I don't matter. Yeah. So, I mean, that's just the way it works. And like I said, you will just understand automation gets you short-term gains to the market, but the market eventually reprices.
Can we assume, or do you take out subs as well as materials in this definition?
I do. Now, when you're talking about subs, let's talk about subs for a moment in terms of cost of goods sold. A sub is another company or person I don't control, that I use on a turn on, turn off basis.
Yeah.
If I have a contractor who's acting like my employee, I'm not trying to be IRS compliant, with 1099 versus employee issues. And we will put individual contractors that essentially I'm telling them when to go, where to be, and they work exclusively for me, which we see that in the construction industry, quite a bit. Yeah. Those people I would call direct labor. But if I am subbing a particular aspect and they're just a jobber, that covers one piece of it that I don't self-perform, they're COGS.
Yeah. So if it's a specialty, lower markup.
Absolutely. Yeah.
Got it.
Well, and there's an aspect. I mean, here's the other thing. We get confused about pricing conventions versus, the economics of management of the business. A material doesn't show up on its own. A subcontractor doesn't show up on its own. And, one of my good friends that was a client and just a great business, just a great entrepreneur, Ron Hollis, had a company called quickparts.com. And I credit Ron with this idea. And he said, we'd sit around and geek out about business all the time. And he was saying, the way he looked at business is, there's four things that happens in $1 of business transaction. You got marketing, then you have sales, then you have oversight of the project or service, and then you have the actual delivery of the product or service. And he theorized that marketing is worth 20% of the dollar, sales is worth 10, oversight's worth 10, and the product or service is worth 60. Now you can take each of those and plus and minus up a little bit, but you can't go a whole lot further than that. And so I've always taught my contractors, both in landscaping, construction, all of these, that listen, you're trying to get at least 30% cut because you had to market it, you had to sell it, you had to get it to contract. And if you're doing hands-on management, you need to push up into the 35 to 40% range. Mm-hmm. And some of my successful building contractors, I've got some renovation contractors that they consistently get 40% contribution margin, and 40% gross margin off of their jobs. And so they don't self-perform; they're just managing contractors. But they're the tops; they're the best of the best. Whereas a lot of people are back in that 25 to 30 range,
or less.
Less.
I see so many contractors doing, 10% markup. It's like, why bother?
That's right. And you learn that. I mean, I did a lot of work in the government contracting industry, earlier on in my career, and still have some clients in that industry. But their concept of material and sub handling, they specifically count time towards material acquisition and sub management. Post that time, load it with overhead, load it with G&A, and you basically learn a theory of that material didn't magically show up. It's not pure magic, that it just made it there. And so I think once people understand conceptual thinking, along those things, they learn to price better, in that process, because you can't just pass that cost through and think that I didn't do anything.
Yeah. There's a trend. I'm a little segue to a different question here. There's a trend towards people measuring their profit in terms of EBITDA because they're thinking about valuation, and that's all
Yeah.
that's all the that's what everyone's talking about these days. And in your book, you say, no, that's a mistake. You've got to understand your profit number. Can you explain that?
Yeah, because the profit number, in cash, it is about cash generation. And, there's sloppy metrics that the acquisition marketplace comes up with that are just rules of thumb. And then once you go through due diligence, you start to find out what matters.
Yeah.
Businesses, EBITDA is fine if it's a business that doesn't have any fixed assets. It's okay. That's just pre-tax net income in
Yeah.
reality. But if you are a capital intensive business that has a lot of fixed assets that depreciate, and oh, by the way, don't confuse tax depreciation with book depreciation. Economically, you should be looking at book, tax. That's just a different discussion.
Yeah.
But we've started really more focusing. In a lot of our models, we'll take equipment intensive businesses and move depreciation up into facilities. And essentially what we're looking at is what we call net operating income. That's essentially EBIT, earnings before interest and taxes.
Yeah.
And I think if you're a equipment intensive landscape company, you've got to be honest with yourself that every one of your tractors, trucks, forklifts, backhoes, they wear out. Now, some of them are long lived, but they carry maintenance too. So
yeah, I think part of what you're saying is you can look at EBITDA, but when someone's going to buy your business, you're going to go back and evaluate all your equipment.
Yeah. Well, and from a capitalization standpoint, what I like to do is operationalize cost for capital intensive businesses. If in a landscaping, I'm fine with doing equipment notes over the effective useful life of that piece of equipment, so that therefore depreciation matches my note payment. They're essentially, if I do book depreciation and note payment, they're going to be roughly similar. And so that's why EBIT becomes a more correct number of taking that depreciation and putting it into facilities, because that truly is telling me, hey, here's the net cash flow after I've made note payments, and I'm seeing that on the P&L.
Gotcha. Salary cap, you mentioned a little bit earlier, and in your book, you talk about if your net profit goes below 10%, you should stop investing. And when it's above 15%, you can start investing in people.
Right.
Do you want to elaborate?
Yeah. In landscaping, industry does kind of fall into that, at 5%, you're on life support, 10%, you're an okay business, 15%, you're great. You're not going to make a lot of economic progress unless you're above 10%. So we consider 10%, as I say in the first book, the new break even.
Yeah.
To more fine tune it, because a lot of the landscapers have fallen into more contracting and less self-performance. There is a second way of looking at it, that I take that 5, 10, and 15, and move it up. That if you look at profit to gross margin, I actually want to, because if you're doing a ton of pass through, and you're not self-performing as much as you did.
Yeah.
When I look at profit to gross margin, I want a minimum of 15 profit to gross margin, targets 20, really humming is 25. So pick whichever one works. And a lot of times we kind of nuance that, with a client of which one is clearer. I would say that probably for myself or the clients that I talk to, I'm more gravitating to talking to them about profit to gross margin of late, than the actual net income number, because if you're running through a lot of dollars and passing stuff through, it just distorts it. You don't see as fine tuned of an action, metric,
so
from
you're
it.
10%, which means you're good, but not great. You're saying is profit to gross profit.
Yeah. At 10. So profit to gross margin, that 10% profit to revenue number, the equivalent to that would be 20. So you move it up 20%. I remember you move it up 10%, to higher, because it just equates better. Because there again, what we're seeing in the contracting world is, you know, each contract is vastly different. Some are pure services, some have pass-throughs, and we're starting to find that it's just better to really look at gross margin. And I always say gross margin is the true economic top line of the business anyway. Revenue is just a fantasy number. So that really becomes, the super focus. And if you push through gross margin, that gross margin dollar is the dollar I can spend internally in the business. I can't spend a revenue dollar all inside the business. Some of that's got to go to COGS.
Yeah. Okay. So the 10% number, just to get super clear here, is based on your gross margin number.
The 10% profit is to revenue. I want it to be 20% profit to 20% profit to gross margin.
Gotcha. All right. Now I'm clear.
Yeah.
So you gave us 3 indicators when we started out here.
Yeah.
Cash balance or cash flow is the third. How do you talk about that?
Yeah. So that's what we call the core capital target. So probably one of the most impactful metrics that we've come up with, I would say, is, years ago, I would get frustrated that I couldn't convince clients to keep cash. It would be heavily leveraged. You'd hit a bump in the marketplace, and all of a sudden they'd be in trouble. And I just kept studying the data and said, what is the deepest negative cash flow cycle a business has in a 3 to 4 year period? And I really couldn't find hardly any indication that it was greater than 2 months of operating expenses, and that everything you don't have terms on. So it's all labor and then all your operating expenses. So you don't include COGS. So it's just all labor and then your facilities, marketing, management labor, payroll taxes, and OPEX, general OPEX.
And loan repayments.
No, you don't. The loan repayments will kind of take care of itself. So but the idea is that you got to have 2 months of those OPEX expenses. I don't count anything else. I don't, and that number has stood the test of time. It was golden during the COVID disruptions, every cycle, and we've gone from, I couldn't get clients to keep cash, and now they're lobbying for 3 and 4 months. And I go, no. I've not seen anybody need more than 2. Now I said, now if you're concerned about the future, take the money out of the business, hold it in a personal savings account, and recontribute it if you ever need it. Everybody that I've had do that for that 3rd and 4th month, they've never put it back in, ever.
There are
happened yet.
exceptions, like if you're working for a builder who's giving you 3-month, payment terms or something. If you're in a business where payment is very slow, I would assume that would be the exception.
Yeah, I just haven't seen an exception yet. Because there again, if you're fully the reason why people would be cash starved is they're not pushing on terms. So, the other thing that I talk about in the 2.0 book is we came up with this concept of what we call trade capital, which is take working capital, current assets minus current liabilities, but exclude cash and debt. So it's just AR plus inventory minus AP minus deferred revenue. That net number as a percentage of your rolling 12 revenue becomes an indicator of, are you a cash flow positive growth business or are you a cash flow negative growth business? And I will say that it may be the second most impactful number that we've talked about, because as I've gotten people's head around, it's the net of those numbers, not any one individual number. They've learned to manage it better. And we've taken people that, and the way we describe it is, if your trade capital is a percentage of trailing 12 revenue of, say, 10%, and I'm at 5% profit, well, I'm going to burn 5% cash for the next new revenue I put in. I got to invest money to turn it over and then wait to get paid. If I can have a 5% trade capital and a 10% profit, grow all you want. I'm cash flow positive for every net new sale.
So
and that's what we teach.
Repeat the trade number. It's AR
plus inventory. Well, it's all your current assets other than cash. So, at AR, inventory, other current assets, like prepaids, those kind of things, minus accounts payable, accrued expenses, deferred revenue. So I'm taking the asset. This is the fallacy of the poorly designed balance sheet that Pacquiao came up with in the 1400s, and it hadn't evolved since then. Is the balance sheet, we put assets on one side and liabilities and capital on the other. The reality is you should net things together. So current assets net of current liabilities, excluding cash and debt, should be in their own category by itself. And so you net those, what we call trade capital assets that turn over. These are the active things that move with every transaction. And you net those and understand this is the basic cash investment that I have in my business. And this is an industry, landscaping and tree care and all that industry is vastly different from business to business in terms of who's good at getting paid up front, who's bad about, waiting to get paid, or and not using vendors, that give you decent terms that are fair. I mean, you don't want to abuse anybody. You want, business works great when cash moves fast, and that benefits everybody.
So just to repeat what you said, so when that number is higher than your net profit number, you're in trouble.
Well, I mean, there's plenty of businesses where that is just the fundamental case. You can try all you want, and you can improve it, but you can't defeat it. And so those are capital intensive businesses. So you got to find a way that I either do what we call base camp growth. So you grow until you run out of cash, and then you intentionally pause it and let the cash catch up. And then you turn on the growth engine again, you grow again. Or, as we sloppily teach in the world of entrepreneurism, just go get a line of credit. Well, have you talked to a bank lately in terms of their, how confident they are in your ability to be a stable business and repay your debt? They come and go. And the thing is, banks are totally countercyclical to the needs of the market. They're giving out money when we don't need it, and they don't give us money when we do need it. And so they're not a reliable partner, in a lot of cases. And I get, I mean, I was a controller for a bank for 3 years before I started my practice. So I've been on that side of the table, and I get it, but for entrepreneurs to think, I mean, I've had entrepreneurs tell me that they think of their line of credit as cash. And I go, no, you realize every line of credit issued in the last 30 years has an immediate call provision? You don't have longevity in that source of activity. The bank can turn it off in a moment's notice.
Yeah. And with interest rates going up, I think everyone's a little more sensitive to it now.
Absolutely. Yeah.
In your second book, you write about return on invested capital. I love this section. You mentioned that basically a return on is that the same as return on equity?
No. No, because equity is and I learned this. David Wessels, who's a professor at Wharton Business School, he's the lead professor for an EO program I chair and get to participate in every year at Wharton for EO members. And the first year I was in a class, David was going over that, and he said, one of the worst metrics in finance is return on equity, because equity is just it's a plug number, from assets minus liabilities. And so what you do is invested capital is you go through the balance sheet and the P&L, or the balance sheet on the assets and liabilities, and say, what are active business necessity assets? Cash, AR, inventory, but things like goodwill, things like assets purchased that don't really have anything to do with the business, intercompany loans, due to, due froms, loans to shareholders on the asset or liability side. You take those out. And so you're getting down to just invested capital is the net of all the business productive assets minus the business necessity liabilities. And you get to that net number, that's your invested capital. Got it. That's what you're trying to get a return on. Now, in the public markets, they think 20 to 30% is a good number. Now, that's after tax. In the private market, I've adapted it because tax is all over the place. So let's just go with pre-tax. And so I've established the minimum acceptable return. And I've yet to see a viable business in the U.S. fail this standard. Now, there's plenty of people below it, but they can get there. Is minimum numbers 50% return. So every productive business that is run correctly, no matter what the industry is, should produce a minimum 50% pre-tax return on investment. And that's like getting a 50% CD, folks. I mean, who wouldn't want that? Now, that's the minimum. Our 100 company model, that's $1 billion of revenue, those guys average about 75% return. And that's a blend of a lot of different businesses.
Yeah.
And companies that are in industries that are, not capital intensive, you get paid upon service, or you get paid in advance, and those kind of things. Those companies, if you're a monthly recurring revenue business and you get paid at the first of the month before you do anything, those businesses operate off of 100% plus return on invested capital.
Yeah.
So those are purely executional growth businesses. They do not require capital to grow. They require faithful execution to grow.
So is there a corollary between return on invested capital and return on equity? Is there some when
it just depends on how trashy your balance sheet is. Now, if you are, so one of the favorite things that people like to do is if you're lazy and don't want to go get your growth, you want to go buy your growth. Well, there's a penalty for that. And you're going to buy a bunch of goodwill because you can't make the assets equal the price that you paid for it. And so those companies, if you got building goodwill from buying businesses that the assets just don't match up, because that's the plug number, you're going to have a bad return on you're going to have a bad return on equity, but you might have a good return on invested capital. Now but there again, even with that one, when you go buy a business, think of it like this. If I'm saying 50% return on invested capital is kind of our minimum standard. If I go buy a business for 5 times EBITDA, $1 million of EBITDA, I pay $5 million for it. And the business continues to produce $1 million of EBITDA. Guess what? I have a 20% return on invested capital because I paid $1 to get that $1 million, So acquired businesses are naturally depressed from a return on invested capital standard. And so I talk about this in the 2.0 book. Listen, if you buy a company at 5 times EBITDA, you need to double it within 3 to 5 years max to make it that gets you up to about 40% return on invested capital, because the capital to grow it from 1 million to 2 million EBITDA is nowhere near what you paid for it to get to that million. I mean, it's a fraction. If it could be even zero. If you're a business that gets paid in advance or has deferred revenue, like I said, growth is execution. It's not capital intensive. If you pay 10 times EBITDA, guess what the inherent return on invested capital is of the company you bought? 10%. That ain't too spiffy. No. So on 10% purchases, you got a 4x it, in that 3 to 5 year window. And the error that I see, let's talk about acquisitions for a quick second, because it continues to be a hot topic. The error that I see in negotiations is the buyer is justifying overpaying for the target by giving them credit for the things that they're going to do post-acquisition. And I get it. I mean, that's the whole, anytime a premium is paid for a business, it's because of what the buyer thinks that they can do with it, and they've got to pay a premium to get it out of the hands of the seller. And I get that. And there's times that you do have to pay a premium to get it out of their hands. But right now, I mean, we're saying, multiples have come down, probably at least 2 ticks. And debt finance deals are almost dead. I mean, there's not really any, there's not any steam in the market, especially from private equity deals. That debt's just not feasible.
Is that what a leveraged buyout is? That's a debt.
It is. Yeah. So what you're seeing more so likely now is you take debt out of the equation. They're going to give you some cash from their fund that they raised, but then they're going to make you roll your equity into their deal for a second potential sale when the market kind of is a little more favorable. And, and that could be a good deal,
Yeah.
and you got to decide. I mean, there's a lot of different decisions that go into that, but those are the common errors every day. I mean, I'm on one of these discussions every couple of days, from both sides. I mean, I talk to buyers, I talk to sellers, and so it's an interesting emotional dynamic, because once that dog gets a hold of that bone, they just don't let go. I got to do a deal. Got to do it. No, you don't. No, you can always walk away.
Hmm. Yeah.
Doesn't matter if you're the buyer or the seller.
So, all right, good. I like that. I'm going to have to go back and
Yeah.
do some research, because we look at return on equity. One of the books we follow is Managing by the Numbers, which is an old book.
Mm-hmm. Well, Managing by the Numbers was done long before a lot of creativity and accounting, came up with. Unfortunately, my peers have created generally accepted accounting principles that I contend are probably more designed to hide the truth than illuminate it. So once again, I think, the finance people have kind of learned, hey, you got to go through and do a scrub, and you got to look at, invested capital is the more pure play number of understanding what's there. And you see this in the acquisitions, standpoint, because, almost all acquisitions of private companies are asset acquisitions. They're not only if you have contractual issues or they're buying the entity itself.
Yeah.
And then even if they do buy the entity, they strip out all of the unnecessary assets and liabilities and make you keep those or clear them up, pre-transaction. So that's the reason why equity, it almost all your listeners, if I pulled up their balance sheet, they've got trash on the balance sheet. And
Yeah.
so, as we say, all the dead bodies in your business are on the balance sheet.
So you referenced that some Italian guy, what was his name, invented the balance sheet?
Pacquioli invented accounting in the 1400s.
And it hasn't been updated since?
Nah, it's pretty much, assets on the left, liabilities on the right, debits on the left, credits on the right. So.
In your book, you also talk, or in one of the two books, you talk about budgeting is not as important as forecasting and, I suppose, reforecasting.
Constantly. Yeah. It's understanding your model. So I wholly subscribe to Jack Stack and the Great Game of Business concept of constant reforecasting. I mean, great, put a plan in place, and January 1st, take that plan, stick it in a drawer, and never look at it again. Because business is very dynamic. You've got to understand. Yeah, you want a target of what you're aiming at, but the reality is, holding on to a plan that is not going to work isn't helping you. And so I must look at dynamic. One of my clients recently, I did a planning session for. I told them, I said, listen, guys, they were a $50 million business, and I said, I got one number for you, two. What does that number mean? It says your sales guys have to sell $2 of gross margin every week for that week's payroll. Doesn't matter what that payroll does. I mean, I don't care if they're, shop labor or executive labor. And we know what our payroll is for that week, and they sell every week. And I said, and some weeks you're going to win, some weeks you're going to lose, but you got to make it up. And so, when you look at businesses like that, it's not in the operating expenses. I mean, you can't cut kitchen supplies enough to get profitable. It is really about that concept of generating the requisite amount of gross margin for every dollar of labor on your team. And is it my direct labor that's falling down? Is it my management labor that's falling down? And
by the way, in landscaping, we call that the cost of uniforms. You can't cut the cost of uniforms enough.
That's right. That's right. Same difference.
Yeah.
And so therefore it becomes that thing that, just like an NFL franchise, now in the NFL, they've got a salary cap. So every team, spends the same amount of labor, but a disproportionate number of teams make the playoffs in the Super Bowl. Business is more like Major League Baseball, where you can spend all you want, but if you have too big of a payroll, you might win the championship and get the sales, but you lose the game by not making money. And you might even become financially distressed. And you end up, and you see teams dump payroll all the time. Well, that's business, and there's a penalty clause for that. And so once again, at the end of the day, there is a finite, connection of margin relative to labor. And there's a few outliers. I mean, if you're in the staffing world, staffing industries have a much lower total LER. They're probably around $1.50. But and the three on the high side would be retail, distributors, and union shops. They all need about a 250 total LER, compared to, but almost all the others is about a 2. I mean, you got a few that'll find a way to sneak above that number, if they've got kind of an ability to where they have low operating costs for some reason that they've been able to kind of work that. But
So
there
where would you
again,
put landscape, which has a lot of equipment?
they're pretty. There are 2. I mean, yeah. As we talk about kind of our material, 1.9 to 2.1 is your range. 2 is kind of the midpoint. But
Yeah.
I mean, you can be nicely profitable at a 1.9, but we want them to aim for that 2. Now, the problem that you got in landscaping is, okay, I'm well above a 2 during my good season. What depending on my geography, what do I have in the off season?
Yeah.
And so that's the challenges that they still have, that seasonality thing to work through.
I
And
think the other challenge is the subs, and I understand the definition you gave earlier, but there's a lot of use of subs and there's a lot of gray area. And so, and some subs come with labor and materials, right? And many don't.
yeah, but see, that I don't care. In my case, I don't, I'm just, see, when I subcontract something out, I'm giving away that piece of revenue, and I have to give away enough revenue that sub can be profitable to stay in business to do it. So that's why we subtract it out. If it's $1 million job and 500,000 of it is subcontracted, I didn't have $1 million contract. I got a $500,000 contract.
Yeah.
And in that 500,000 that I get to keep is my service for managing that other 500,000.
Right. And so
you want
a 2 times 2 to 1 ratio on that.
Yep.
Based on that $500,000. All right, that makes sense.
Yeah.
If you have time here, I want to talk about your valuation formula.
Yep.
You wrote in one of your 2 books. I think it was the first one.
I think it's actually discussed in both.
Yeah, I'm sure. 3 years pre-tax profit plus equity on the balance sheet, I assume.
Right.
Where does that hold true? Is that hold true for private companies of a certain size?
It holds true for all privately held businesses. And now here's the thing: that's not necessarily what it trades at, because as I said earlier, when the marketplace needs your business more than you, they got to pay more than that. So that's the premium. So I consider 3 times net income plus equity the neutral value of a business. And so and you'll see this in terms of, if a business is equity starved, it's one of those that you'll get your 3 times net income plus what equity should be, but you got to leave part of your sale price in for the working capital deficiency for the buyer. And I will tell you, in due diligence, do not overlook the working capital at closing requirements. That I've had more arguments between buyers and sellers who did not figure that one out before they definitized the agreement. And there is not a common mindset in terms of how that works between buyers
who's
and sellers.
Responsible for it?
Well, or how it's calculated.
Yeah.
And so there's not a standard way of doing it. So therefore, if you ever do get into a transaction, before you say yes, you want to know specifically, and you sample a calculation. And so, well, here's what your words say. Here's my calculation. Is that what you're saying? And they'd have to say yes or no. And you got to work through that specific example, with the existing data before then at closing that, because that's a moving target. It's not going to, you might agree to it on June 30th, but by the time you close on September 30th, that thing moves every day, and you either get more money or you have to give them money if that number's not the right peg, at close.
Most small business owners won't really know how to answer that question.
Well, that's why they need guidance. They need to hire somebody that does know how to answer that question, because I'm telling you, it can be a massive number.
Yeah. Your formula, I think, works, but I think below a certain size, all bets are off, and sometimes you're just buying the book of
Yeah,
clients,
yeah.
and the
I mean,
assets.
certainly.
Like
I,
I see it where there's assets and a book of clients and a very small business, right? When you're just
right.
sort of folding it in.
Well, I mean, if you're below $1 million in revenue, are you a real business or not?
Yeah.
Maybe, maybe not.
Right.
But there's still a ton of business. I would say that the gravitation, especially in the landscaping industry, is if you don't have $1 million of revenue, you're basically selling gross margin of your known clients who will repeat, and you're probably going to have to do that on an earnout anyway.
Mm.
So most of those deals are very rarely cash up front, unless the buyer, for some strategic reason, needs you more than you need them.
Yeah.
And I said, I mean, you go into these transactions of, yes, you need to know the basic parameters of how things work, but you might be the unicorn. You might be, so don't give up on that until somebody says, no, I can't do that.
Yeah.
Or else as a seller, you're going to leave money on the table. As a buyer, I mean, I get sent data every week, by clients looking to buy a target, and I run through it and I go, either, yeah, this looks good, or you're nuts, one of the two. And
You just had a negotiating technique, which has I've had stuck in my brain for like 20 years. I read the negotiating book by Trump's number two guy. This is like from 20 years ago. I forget his name, but he said their whole negotiating strategy was they keep asking, keep asking, keep asking until the other side says, "No, I'm sorry, I can't do that."
right, yeah.
That was their whole approach.
And that actually is, pure technique of how do you find that equilibrium where the buyer and the buyer is paying more than they want to, and the seller is getting less than what they want to. And that's when you've hit the proper price in reality.
When they're both unhappy.
Mm-hmm. Yeah.
My accountant used to say that all the time.
Yeah.
So
Sad to say.
Yeah, in closing up, let's talk about the future. What do you what do you see for the economy in the next 12 months?
Well, I mean, I think we're living in a world of a stuck economy, because I'm a big believer that labor is the major driver of true economic outcome. Now, I think the government's data is crap. Um, they're looking at public company data, trying to do wild mathematical extrapolations. Private company have started to dominate the U.S. economy, and the government is just totally blind to that activity. And so that's why we do the simple numbers 100. Our data is showing that revenue of those $1 billion of companies has declined since October of 22. So our data would say we've been in a recession since fourth quarter of last year. Now, recession, big deal. I mean, the reality is, what's important is the market is adapting to the labor that's available. So in all previous recessions since World War II, there's been 7 to 11% unemployment. We don't have any unemployment. Do you actually personally know somebody who's unemployed that really is trying to get a job to feed their family? No, most of us do not. We don't have unemployment. We have a marketplace that is adapting to itself. So I, I don't really care about the word recession. What I care about is you got to look at each individual business, each individual market, and say, what is your potential? And, if you're in Florida and you're a landscaper, you got growth. There's inbound people. My landscape oriented connected clients in Florida, they're doing good.
Yeah.
If you're, in a flat uh, population environment to declining, you're going to struggle. And because the you're going to not have labor. So you got two things working against you in those. My customers are leaving, but my labor is not stable either. And so so you have a spike in labor cost, and I can't grow because there's not growing customers. And this is going to be a new experience. I mean, I'm totally aligned with the data that Peter Zion talks about, in his book, The End of the World is Just the Beginning, but also just his ongoing stuff of looking at population demographics. I don't think we've talked enough about, Elon Musk has talked about this as well. I mean, we're in a changing world right now because we've enjoyed economic growth since the beginning of time, but this is a different time.
Hmm.
And all of us are just guessing as to how it plays out. And I think, for each individual person listening, they've got to look at their market and say, am I growing or declining in population in my market? What is my access to, labor that I can go do the stuff with? And I got to look at the economics of the household incomes of my primary customers and say, are they faring better or faring worse? Because I will tell you, what we are seeing are with our clients who sell products or services that are highly discretionary, they're the ones that are bringing that total revenue number down right now.
Hmm.
They're hurting big time. Our
So people
retail
are
clients,
spending less in
people are
discretionary.
right. People are spending absolutely less, and it's just because their dollars are not going as far between housing and food cost as the two primary. It just doesn't leave a lot left over, and so I mean, I think it'll be an interesting thing to see. Now, but here's the thing: does it mean I can grow? Absolutely, but I refer to this as the street fight economy, not the participation trophy economy. From 2008 until recently, probably or right before COVID, I would call that the participation trophy economy. You could be a bad business and still grow because the market was growing everywhere. But now you got to go take business. You got to punch your competitor in the mouth and go take away their customer.
And
And
it's the Woody Allen economy. 80% of success was just for showing up.
that's right. That's right. And so I think, there's a lot of entrepreneurs who are not really cut out for punch your competitor in the mouth tactics.
Yeah, actual competitive business.
That's right. Yeah.
And so I'm just going to rephrase. You're saying look at the macroeconomic trends and then
Hmm.
look at how they're impacting your local market to
That's right.
understand what's happening.
Yeah. Yeah. I mean, if you're in Nashville, Tennessee, you got a wildly different economic outcome than Baton Rouge, Louisiana.
Yeah. Or, yeah, Connecticut, where I'm used to be from. I'm now from New Orleans, which is
That's right. Yeah.
kind of blue red in terms
Hmm.
of, the
Yeah.
economy.
But see, I mean, there's two southern states that are losing population, Louisiana and Mississippi.
People don't
And,
want to
and
live here.
that's right. Yeah, I mean, there's plenty of people who do, but they are not growing, and they are actually losing, some of that. And so once again, you got to look at your situation and say, I gotta be honest with myself about the demographics of where I'm at
Yeah.
and the area that I serve.
Right.
And and as Professor Wessels, I'll give him another credit for this. He had a great phrase that he said the first year that I love. He said, sometimes you have to change your where, not your share.
Hmm.
And I think, once you've milked a market for the reasonable the next percentage of share that they get isn't worth it. You got to change your where,
Yeah.
and you got to expand geography.
Yeah. Yeah. We just ran a master class on building branches,
Mhm.
and the three presenters there spoke about maximizing market share, but maximizing doesn't mean 100%.
That's
It
right.
means some bell
I,
curve,
I would actually say optimize is
Yeah,
probably the better term that
correct.
I gravitate to.
Right.
But I
And
mean,
then
we had a multi-location, landscaper out in the Southwest, and um, when they opened up a new location in Vegas, it reset the operational metrics and exposed some of the laziness of their existing locations before they opened that new location in another city.
hmm,
And they go, oh, we've kind of, fallen down here. So there's a lot of learning that comes from opening up new locations in a different geography because you start to reset operational standards that you thought weren't possible when they really were.
so what's your stance on this? Is not a political question, it's an economic question. What's your stance on
Mm.
immigration based on what you were just saying beforehand?
I wish our government operated the way Australia does. So my Australia clients, one of my clients is in the Northern Territory, and they were able to get an electrician immigrated from Zimbabwe and got him approved in 24 hours. And he's on a 4-year visa with a path to citizenship. And it's like, hey, that sounds wonderful. So the Australian government recognizes that they got a shortage of skilled labor. So they opened up 450,000 skilled immigrant visas. It's like, gee, what a novel idea.
Yeah. A 4-year visa, not a 7-9 month visa.
Exactly. And so once again, I mean, there's, I don't have any hope that either. I mean, the political parties can't even agree amongst themselves, much less agree, bilaterally across themselves.
Yeah.
But the U.S. is in we're still a desirable place to be. And so while we are, this would be the time to go get that skilled labor.
Yeah.
But I'm not holding my breath. So, I mean, so the other trend is you grow your own. And so the vast majority of our trades clients, they are investing heavily in growing their own laborers and trying to it's a cost that gets added to the business, which is a cost that escalates the price you charge your customers, and is what it is. So.
Yeah. Any final words you want to leave the audience with?
It's still great to be an entrepreneur, and I would still highly recommend it to anybody that. But it's we're gonna have a separation of the good entrepreneurs versus the weak entrepreneurs in the next 5 years, and I think we're gonna have a clear delineation between the winners and the losers.
Yeah.
And you're gonna see markets where you got 15 competitors and it'll shrink to 10. That's not a bad thing.
Yeah.
Nobody's going to be unemployed when that happens. They're just going to shift to the better companies, and the better companies will survive. But we're going to go through the great, workplace transfer portal here, over the next few years of the skill moving to where the best place for them to be. But I don't see any. I mean, it could. I mean, I could be wrong. I'm just a chicken farmer from Alabama by trade, so but I just don't see any unemployment in the near future or anytime soon.